Okay, and then we'll discuss. So I'll share my screen. So what I'm going to do is I'm going to open a Google Sheet and we'll start from very basics. Okay, so we'll name it real estate and I'll share this sheet with you. Okay, so I hope you can see my screen. Can you see my screen? Okay, that's good. So we are going to talk about real estate. So we'll first start with what are the different types of real estate you can invest in. Okay, so you can invest in different types of real estate. You can invest in a residential property where you or any tenant is going to live. You can invest in a commercial property. Okay, where you are going to rent it for any business. So there are basically two types of real estate: residential property and commercial property. You can also buy land and rent that land out if it is a farming land. Okay, so three types of investment: residential property, commercial property, and land. Now within residential property in Canada, there are basically three types. You can buy apartments, you can buy townhouses, or you can buy house, a detached house. Okay, so within residential property you can have an apartment. Apartments are basically, like, visualize it like a condo unit. So you have, let's say, 20-30 units in your building and one of the units belongs to you. Okay, townhouse are similar to apartments, but the number of people living with you are lower. So let's say a attached townhouse may just have another family living besides you. A detached house where is like you have separation between different houses. Now main thing is, in an apartment and a townhouse, right, in both of these there are some common areas that you have to share with other tenants, and there are some, right, private areas that belongs to you. In a detached house there are no common areas within the house that you share, right? So everything is private. So this is a big difference between apartments, townhouses, and detached houses. In an apartment and a townhouse, there are common areas and private areas. Common areas you share with others, private areas you keep to yourself. In a detached house, most of the things are private. So most of the areas you have ownership on. Okay. Any questions till now? Any questions with these concepts till now? If you have any questions, please put it in the chat. Okay. Now, this part is really interesting now. How can you buy real estate? Or before that, let's decide whether to invest in real estate or not. Okay. Or we can also say benefits of investing in real estate. Now, basically, you have two options. You can either rent a place or you can buy a place. Now there are a lot of advantages of renting. There are a lot of advantages of buying. We'll first discuss the advantages and then we'll look at disadvantages. So what are the advantages of renting a place? The biggest advantage is it is less costly to rent. You don't need down payment. Okay. You don't need big down payment. Plus, rents are usually, it depends on the economic situations. Rents are usually lower than mortgages. So most of the times it is true, in most cities it is true, but not always. So if you see right now, so rents, there was a recent article, rents are lower than mortgages. So BNN Bloomberg had an article. So if you read that article, it's quite interesting. So if you read that article, it says that in most cities, right? Example, the Toronto, they are comparing the average mortgage is 3,300, but the average rent is 2,300. So it is $1,000 lower than the corresponding mortgage. Okay, if you see other areas like let's say Vancouver and stuff, the concept is same. The only cities where it's not true right now is Western Canada, where the average monthly mortgage in Edmonton is 954, which is 19.22% less than the rent of $1,100. So only Calgary and Edmonton, that amongst the big cities, are is a place where mortgage is actually, even with the interest rates increases, mortgage is actually cheaper than, like rent is mortgage is actually cheaper than rents. Rest of Canada, most provinces, right, what is happening, the rents are right now cheaper than mortgages. So it depends on the economic situation, interest rates and stuff, but usually rents are lower than mortgages. This is one of the big benefits of renting. Other advantages are it's easy to move. If you have to move to another city, or if your job is not that fixed, you like travel a lot for work, or you live like you have a nomadic lifestyle, so in that case renting is a better option because you can just pack and leave. Okay, then the other option is, the other advantage is you don't have to worry about maintenance. Okay, so most maintenance is like replacing a roof, right? Then furnace not working, all those issues, the responsibilities of the owner. You as a renter do not have to worry about that. Minor wear and tear, right, you do have to worry about it because it might be in the rental agreement. But major repairs that are part of owning a house, like replacing the roof after every 40 years, then replacing the furnace, right, all those things you don't have to worry about. Okay, there are disadvantages though to renting. Okay, so what are the disadvantages to renting? So disadvantages: no security. So if you're renting a place, your landlord may want to live there or may want to like re-rent it to someone else, then you might have to move. So they will give you some notice period, but after that you have to move. So there is no security. Okay. Also, renting a place doesn't create home equity. So when you rent a place, you're paying someone else's mortgage. Whether you're paying it in full or whether you're paying it in part, that does not matter. But you are paying someone else's mortgage. What does that mean? That you are not creating any home equity. What is home equity? Home equity is difference between house price and mortgage. Home equity is the difference between the price of the house, the market price of the house right now, and the mortgage. So as you pay down your mortgage over the years, when you own it, your home equity starts to grow. But if you're renting, you're not creating any home equity. The house that you're living in, right, is not your investment. Okay, rent is an expense. Once you pay the rent, you're never going to get it back. Okay, major disadvantages of renting a place. Now, buying a place has some advantages. The biggest one is you create home equity. Home equity is you buy a house, you take a mortgage on that. Over the years, you slowly pay the mortgage down. As you pay the mortgage down, the difference between market price and the mortgage keeps on growing. And maybe the house is appreciating too. So that also creates the larger difference. So as the difference grows, your investment in that house grow. So you do create home equity when you buy a place. Okay. So that's one of the big advantage of buying a place. Then it is also more secure to have your own house. So you have security in place. So no one is going to ask you to move unless and until you want to move. Okay, so you have a house, right? So that brings in security. There is a lot of pride in ownership, especially in some ethnic backgrounds. They attach a lot of pride to having a house. Okay, so this is thing. And also there are two advantages when you buy a real estate place. Some you can maybe rent it, so you can get rental income out of your house. Also you might get benefited out of appreciation in real estate. So if the real estate prices appreciate, your investment will probably grow. So when you buy a place, you are exposed to the possibility of renting it, and you're also exposed to appreciation in real estate prices if the market does well. There are disadvantages. It is more costly to buy a place because you need down payment, you need closing cost, you need, like, let's say, the mortgage payments that you make every month. So the renting is less cheaper, like less expensive than buying a place. Buying a place will be more expensive. Okay, also big disadvantage will be that you need to block your down payment. Then you have to, it's hard to move. Once you buy a place, you might not have the same flexibility that you have when you want to move, and you have to worry about maintenance. Maintenance is your responsibility. So in a nutshell, right, there are two options you have. You can rent a place or you can buy a place. Buying has advantages. You create your home equity, you get exposed to real estate as an asset class, so you can benefit from renting, you can also benefit from real estate appreciation. There are disadvantages too, like it is more costly. Okay, one major advantage that we are going to spend a little bit more time is in Canada, when your residence is primary. So in a primary residence, there are no capital gain taxes. So effectively, to visualize it, one house that you live in, right, when you sell that house, whatever profit you make, you don't have to pay taxes on it. This is the primary residence tax exemption that every person in Canada enjoys. It applies only to one house. So if I have two houses and one I'm renting, one I'm living in, the one I'm living in, right, becomes my primary residence. You can designate it in your tax returns. So when you sell that property, right, you get a primary residence tax exemption. right? So you do not have to pay taxes on that primary residence. But if you sell your secondary residence and make some money on it, then you do have to pay capital gain taxes. So this is one of the big advantage of buying a house, especially primary residence, that it is not taxed. Any questions? Any questions about renting versus buying? Okay. The next part is, right, how can you invest in real estate? So there are different ways of investing in real estate. You can buy a primary residence in which you can live and maybe rent a part of it. You can buy a secondary residence that is an investment property. Why I am separating that? Because there are different rules that apply to primary residence. There are different rules that apply to secondary or investment properties. So you can buy a primary residence. Okay, there is a question. So if I own two houses, it's the first house that you sell that you won't get taxed. It's not the first or the second house. You can tell CRA which house is your primary residence. So what do people usually do? Most of the clients that I deal with, they designate the primary residence the house that is more expensive. So if I have two houses, one is an apartment, one is a detached house. The detached house is, let's say, at 700,000. The apartment is at, let's say, 300 or $400,000. Then I have an option of designating the expensive one as the primary residence. Okay. So the more expensive one, usually you people designate it as like primary residence, and they claim a tax exemption if they sell it. Okay. Yeah. Yeah, it's quite interesting. So how can you invest in real estate? You can buy a primary residence, you can buy an investment property. Okay. You can buy a commercial property, or you can buy something called as REITs, real estate investment trusts. Okay, so basically, and you can also buy land. So land will be the fifth type, but we'll not discuss land that much because it's quite complex. I will briefly give you one REIT that invest in land when we discuss REITs. Okay, so how can you get exposure to real estate? So there are different ways. You can buy a primary residence. Primary residence is your first property, the one in which you're going to live. So there are different rules about it. So the first rule is you need at least 5% down payment. So you need at least 5% down payment. We will discuss what down payments are, and there are certain like strategies you can do while planning for your down payment. So at least 5% down payment you have to put in, right? The rest you can take as a mortgage. Okay, rest you can take as a mortgage. So you have to qualify for a mortgage, which we are going to discuss too. Like what are the qualifying factors for taking a mortgage? Okay, so when you buy a primary residence, you have to put at least 5% down. So let's say it's a $400,000 property. So for 400,000 into 5%, that is $20,000 you have to at least put in. as a down payment, and rest you can take a mortgage of. Okay, so when you are taking a mortgage, it's important to qualify for a mortgage. When you buy a secondary residence, the rule is bit different. You need to have 20% down payment. For investment properties, the down payments are higher. You need to put in 20% down payment instead of less, like 5%. Okay, one big difference. So when you're buying your second or third or fourth property, you need to accumulate higher down payments. Okay, this is one of the major differences. Now you can buy commercial property also. The similar rules apply, 20% plus down payment. Okay, commercial property will be, let's say, a shop or a mall or like something like that that you rent. So these are physical things that you can do: buy a physical primary residence, buy a physical investment property, buy a physical commercial property, or you can buy real estate on paper. So REITs are real estate investment trusts. REIT is a real estate investment trust. So what do I mean by real estate investment trust? So it is paper real estate. Okay, what do I mean by that? So it's a real estate mutual fund. You can imagine it as a real estate mutual fund. So what is a real estate mutual fund? So I'll quickly explain it. So it is basically, I'll make it a bit fancier so that you understand. So these, I'll make two color. Okay, so what happens is, in a real estate mutual fund, there are different investors. You can be one of them. You as an investor give your money to a REIT. REIT is a fund company, a fund management company. So they get funds from investors, right? When you buy that REIT, and once they receive that fund, they allocate that money, okay, into residential real estate, into commercial real estate, or into land, farmland and stuff, or into even industrial real estate. So basically what's happening, you as investors are giving your money to a REIT. REIT is a fund management company. They gather funds from investors and then they make allocations into residential real estate, commercial real estate, or land, right? Or combinations of these. One more type is industrial REIT, so we'll write down that too. Industrial REIT means industries. So this is an indirect way of getting real estate exposure in your portfolio without actually physically buying real estate. Now, what are the advantages of REITs? So advantages of REITs is, first big advantage, you can invest these REITs in a tax-free savings account or an RRSP or an RESP. Okay, so you can include these REITs, right, because they're like listed on the stock exchange and they trade on the stock exchange. You can include these REITs in a tax-free savings account. So let's say if you're including them in a tax-free savings account, whatever dividends you get from the REITs, that is the rents that you get, will be tax-free. Whatever appreciation you get in the prices, that will be tax-free too. So REITs can be included in a registered account and they can enjoy tax-free status. You cannot do that with a investment property. When you buy an investment property, if you are getting rental income from it, you have to show that to CRA and pay taxes on it. Also, when you sell an investment property, then you have to pay capital gain taxes on the profits you're making. But with a REIT, you don't have that. Whatever money you're making, right, you can like allocate those REITs into a tax-free savings account. So that will be tax-free. Okay. One big major advantage. Second advantage is you have, right, utilities of scale, or you have scale. Scale means your money is diversified, right? So we'll write down diversification instead of scale. So you have limitations if you're buying physical property, because maybe you can buy an investment property just in Calgary because you're living in Calgary. You do not have a lot of money to diversify your holdings into Toronto or Vancouver or let's say Montreal, right? So you cannot basically put your money into different locations. You have limitations. But what does a REIT do? They collect money from millions of investors. So they have like maybe $1 billion or more to manage sometimes, and that $1 billion they can allocate into different cities or different territories. So there is benefit of diversification because you're not just focused on one city. You can take exposure to multiple cities, living in any city that you like. So there is diversification benefit when you invest using a REIT. Any questions with this diversification concept? I will give you an example and we'll discuss it more there, but it's quite interesting that in a REIT, diversification helps a lot. Okay. Then there are cost advantages. For example, when you're managing an investment property, if something goes wrong, you have to, like, let's say, call a plumber or let's say a roof guy if your roof is leaking or something like that. Now, they will charge you higher fees. But when you're having, when you, a REIT is dealing with them, they have scale because they have contractors on their payroll, or they have contracts, like they have information about contractors, better pricing. So that's the first cost advantage that they enjoy when they are doing maintenance. Because they own so many properties, they can get a better deal. Second, they can negotiate with banks better. So let's say they are taking a mortgage, right? They are taking some debt for buying properties. They might get a better interest rate than an individual. That's also a big advantage. Third advantage is they can also negotiate the price better when they're buying, because when they're buying at scale, they're investing, let's say, hundreds of millions of dollars. So when you're doing that, you can negotiate better with the construction companies. Okay, so there are a lot of cost advantages when you're dealing with REITs. Now I'll show you some examples of REITs. Okay, so we'll go to Google. We'll first type in RioCan, which is one of the largest REITs in Canada. So RioCan is a mixed REIT. Mixed REIT means it manages and develops retail focused mixed use properties in Canada's major town. So for example, if you look at their investor presentation, the recent one, so they have shopping complexes. Okay, they have like residential complexes. You can read through, but 207 properties, right? $14 billion is what they manage right now. They have exposure to Vancouver, Calgary, Edmonton, GTA, Montreal. So they have investments all through. Okay. Their occupancy rate is quite good. So only like 96% is the occupancy rate. Okay. So this is one example of REIT. So this is a mixed REIT. Mixed REIT means they have some commercial interests, they have some residential interests. So it's a mixed REIT. Now if you go to Yahoo Finance, I'll show you what is the price of that. So if you go to Yahoo Finance and type in RioCan, so this is the REIT that we were talking about. So if you do max, so over the years, this was $6 in 1996, and over the years it has fluctuated because it's based on interest rates, right? So right now it is trading at $18. So if you invest in a REIT like this, you might get capital appreciation. Also, you get access to rents. So whatever rents they collect as a company, they share it in dividends. So you can get access to dividends. Now, good part about REITs is most of the REITs pay you monthly. So this REIT, RioCan REIT, is providing you 5.43% dividend every year. So let's say you're putting $100, so $5.43 will be your yearly dividend. But most of them pay you monthly. Okay. So if you go to historical data, so September dividend, August dividend. So every end of the month, they pay you dividend. Okay. That's a big advantage of, right, REIT. So this is example of a mixed use REIT. Any questions till now? Okay. Another option is Canadian apartment. This is not a mixed use REIT. This is a REIT that focuses on residential properties. So this has gone up from $14 to $29 now, right? So when you buy this for, let's say, $30 per share, you get access to 3.53% dividend. So every month it pays you some dividend. Okay. So when you buy a REITs, so going back to that Google sheet, when you buy a REIT, you get advantage of appreciation if real estate appreciates, and you also get rental income in form of monthly dividends. Okay, you get rental income in form of monthly dividends. So that Canadian apartment was an example of residential REIT. Now there are industrial REITs too. Example will be Granite. So Granite is an example of a industrial REIT. So they have industrial properties that they manage. Okay, this gives you 4.65%, right, dividend. So if you buy this stock every year, you get 4.65% dividend. It might change based on performance, but right now that is what it is. Okay. There are also some specialized REITs. For example, Chartwell is a REIT that specializes in old age homes. So this is a REIT that focuses and specializes on old age homes. So it has not done that well in like recent times. It was trading at $14 in 2019, but it has never recovered from the fall, right? Because old age homes were hard hit due to COVID. So they had a lot of increased expenses due to COVID-19, right? The sanitation expenses and all. So they haven't done that well, right? But something to think about, that there are a lot of REITs that focus on resident like old age homes too. This is another one, right? So Sienna Senior Living, again a Toronto-based company, like done little better than Chartwell, pays very high dividends too. Okay. So REITs is a way of getting residential exposure. Also, you can buy farmland in form of REITs. So this is an example of a farmland based REIT. So they buy farmlands, rent it out to farmers and collect rents from that. Farmland hasn't done well in like lot of years, right? So they do okay. They have done well like since the pandemic hit, but they have come down a lot also. Okay. Questions? So this is a big misconception that you need a lot of money to take real estate exposure. You can do it right now. Spend like even like below $100. For example, Canadian apartment is $30 stock. So if you buy it for $30, you get exposure to real estate in your maybe tax-free savings account. So you don't have to pay taxes on that. Okay. Any questions? Now, if you look at benefits of real estate as an investment, it is basically two ways. You have potential of capital gain. Okay, potential of capital gain means real estate prices probably would go up over the next like 20-30 years. So that's one of the reasons you might take exposure to real estate. I'll just switch on the light so that I can see better. I forgot to do that. So one of the reasons you could invest in real estate is potential of a capital gain. Capital gain is that the real estate price goes up and you sell it at a higher price, the properties that you have bought. Now if you see real estate average returns in Canada last 30 years, this is for United States, we want Canada. Okay, so Canada, like on an average, it's that's not a better side. It is somewhere around 6.3% if I remember correctly, but I just want to make sure of that. Yeah, it is 6.11%. So 6.11% appreciation over a 15-year period. So on an average, real estate price appreciation in Canada is 6.11%. It might be higher some years, it might be negative some years, but if you take a long-term average, that is 6.11%. So that is potential capital gains you can get on your real estate property. There is also, so this 6.11% is average yearly growth. So it's like investing $100,000 and every year it grows by roughly around 6%. Okay. Also, there is potential for rental income. Also, there is potential for rental income. So, rental income in Canada, you can check it out. I'll explain rental yields also. So, always Google and keep a track of rental yields in Canada. So rental yield in, this is an old article. I know this article. That's why I will ignore it because this is an older article. We do not track dollar values of rent. We track something called as a rental yield. That is more important. So I want that number. Yeah, this is what I wanted. So this is Toronto and Vancouver. So this is the rental yield in those cities. Okay. So what is rental yield? It is how much rent you collect versus how much is the property value. So rental yield is a measure that a lot of investors track. It is given as rental income gross, that is before deducting any expenses, divided by property value. Okay, so rental yield in Canada in major cities, Toronto is somewhere around 3.8, 3.9%. Okay, Vancouver it's a little bit higher, it's 3.97 and 4%. Okay, so that's the expected gross rent that you might be collecting. Hmm. Yeah, this is a good way to 3.7 is a gross Canadian rental yield. So average rental yield in Canada is 3.7%. It means for a property of $100, you're going to get $3.70 from it as a gross yield on rent. Okay. Now usually it is little bit higher. If you see in some cities, it is usually lower in some cities. For example, if you see Calgary, the rental yield is 7%. Rents are higher as compared to property prices in Calgary. So if you are looking for rental income, investors will generally go for rental yields that are higher, right? Red Deer, the rental yield is 16%. Okay. For the same property, you will, for the similar price that you are paying, you get a higher rental income. You might not get the same appreciation that you get in, let's say, Vancouver or Toronto, but the rental yields are higher. Okay. Questions? Any questions about how do you benefit? Potential of growth and potential of rents. Okay. Yeah, like a Red Deer, the property prices are quite low, but rents are quite moderate. So that's the reason they generate higher rental yield. So even like Calgary and Edmonton are not bad. 7% rental income on versus, let's say, if you go to somewhere like Vancouver or Montreal. Montreal, the rents are very low, 3.5%. So makes way better sense to buy where the rental yields are higher if you are looking for rental income. But then again, you might not get the same appreciation that you could get in markets like Toronto or Vancouver. Okay, Toronto, the yield is only 3.57%. So let's do a little bit of math. So let's say we are looking to invest $800,000, and let's look at different cities, how much rent they will get. Okay, so this is city. So we'll write down it for Toronto, Vancouver, Calgary, Montreal, and Edmonton. So we are almost covering all major cities. So we'll copy paste the rental yields. So at Toronto, the rental yield was how much? 3.5%. So I'll just write that down, 3.57%. Vancouver, the rental yield is 3.86%. Calgary, 7.14%. Edmonton, 8.74%. And Montreal, 3.57%. So if you just multiply 800,000 with the rental yield, you will get how much annual gross rent you can get. Okay, so I'll just drag it down. So this is a big difference. So if you invest an $800,000 property, right, in Toronto, you're just going to get 20. So this is yearly rent. We can even find out monthly rent. So just to make it more comparable, I'll just shift this here. Monthly rent will be this divided by 12, and we can drag it down. So just to visualize, right? So if you buy a place of $800,000, right, maybe in Calgary you might get even 3 or 4 condos in it, because the condo prices are somewhere around like 250. You can easily get a 1 bedroom apartment. In Toronto, forget about anything, like you might just get one. So that's a big difference. In Toronto, you get 2380 on an average. In Vancouver, 2500. Calgary, 4760. At Montreal, 2380. And here in Edmonton, you might get 5826. So rental yields make a huge difference when you're investing in real estate. Questions? Okay. Now, what do real estate prices depend on? So real estate prices first depends on supply and demand. Okay. In Canada, we have a dearth of supply. The demand is very high for real estate. Everyone wants to own one house to live in, but the supply is not enough. We have a supply crunch. So there are a lot of articles about it. We, amongst the G7 countries, we have the lowest housing supply. So you can research about that, but this is a problem that we have been facing for quite some time. So example, 22 million houses will be required. Looking at the immigration patterns we have, looking at the population growth that we have, we require like 22 million in total, but 3.5 additional affordable houses needs to be constructed by 2030, and we are not hitting our targets. Okay, so there is supply crunch always in Canada. It is different city wise. In Alberta, the like situation is way better than somewhere like Vancouver or Toronto. Okay, so this is in millions how many additional houses needs to be constructed. Major crunch in Ontario. Okay, one of the reasons is we do not have enough skilled labor to construct those houses. Second is bureaucracy, a lot of bureaucracy in house construction, so it takes long time to create supply. Okay, zoning laws, all issues. So that has created this dynamics for last like 2 decades or so, where we don't have enough houses. Unless and until things change a lot, there will be a supply crunch even in future, at least till 2030, 2040. So that means the supply is going to remain low and the demand is going to remain high. That leads to higher prices. So it depends on supply and demand, which we do not have. Then it also depends majorly on interest rates. Okay. For every 1% increase in interest rates, the rough math is that the real estate price goes down by 10%. So when interest rate goes up by 1%, the real estate price goes down by 10%. It has a negative correlation. Why? Because if interest rates go up, the mortgage payments go up and people might not be able to afford that mortgage. So their affordability of house goes down. Okay, so we'll see that when we discuss mortgages, but you do have to like understand right now that interest rates and real estate prices are inversely related. If interest rates go up, real estate prices go down. If interest rates go down, real estate prices go up. So interest rates also determine real estate prices. For the last 20 years, I would say the interest rates have been going down. We almost reached 0%, right, in Fed funds rate. So if interest rates start going up from here, which they have been doing for last year or so, and they continue doing that, that's the projection that most economists have, then it creates issues because the higher interest rates will suppress real estate prices. Okay. Any questions with the interest rate dynamics? Roughly always remember it is 1 is to 10. So for every 1% increase in interest rate, the real estate should go down by 10%. Okay. Third is the economy. Economy determines real estate prices. When people have jobs, economy is doing well, real estate generally does well. When there is a lot of unemployment, like economy is not doing well, right, then the real estate market also struggles. A big example is a town like Calgary or Alberta as a total. Alberta's economy is a lot based on oil prices, because one of the major exports that Alberta does is oil and gas. So if oil and gas prices go up, Alberta's economy does well, and so does the real estate. Real estate prices stay elevated. But when oil prices go down, right, then Alberta's economy also goes down, and so does the real estate price too. So if you track real estate prices in Calgary over the years, so they made a high in 2014 when oil price was very high, and when oil prices started to crash, the economy started to crash, and so did the real estate. So we have the cycles of boom and bust in Alberta. Boom happens when the economy is doing well, right? Oil goes up, real estate prices go up. When oil tanks, our real estate prices tanks too. Okay, so three major factors that drive real estate prices: supply and demand. We discussed about that. Supply is very constrained in Alberta, and like overall Canada, I would say it's way better in Alberta, but not in major cities like Toronto and Vancouver. Interest rates create issues. We interest rates are going up right now, right? So that creates issue. Which interest rate? So you have to always look at the policy rate, because all mortgage are derived from policy rate. So Bank of Canada policy rate, if you see, so this is what has happened. So if you see in, let's say, January 26 2022, the interest rate was only 0.25%. Then Bank of Canada started to increase the interest rate. It went to 50, 0.5, 1, 1.5, 2.5. Now it is 3.25, and there is an interest rate hike expected in, like, on Wednesday, like this is 24th of October. So Bank of Canada makes decision 26th of October. So another interest rate hike might happen. So as the interest rates go up, real estate prices go down, because people might not be able to afford the similar kinds of mortgages that they were able to afford it when the interest rate was 0.25. We'll see what is the impact of that, but that has what has happened. Questions? Okay, so it's almost 7. We'll take a 15 minutes break. When we come back, we'll start discussing, right, about we'll start discussing about how to accumulate down payment. Then we'll go to mortgage, and then we'll discuss few other stuff. So 15 minutes break. We'll start exactly at 7:15 again. Okay, so let's continue. Next is down payment. Part of buying your residential property is accumulating that down payment. Now, if it is a primary residence, you have a minimum requirement of down payment to be 5%. If it is an investment property, then you need 20% down payment. Okay. Now, what should you do regarding down payment? So we'll talk about multiple angles, right? So first is, like, how much down payment to actually put. So if you're buying an investment property, there is no option. You have to put 20% at least, right? Even more if you can, right? But if it is a primary residence, you have a range. So between 5%, 20%, and 20% and above. Okay, so this 20% in a primary residence also is an important threshold. If you put less than 20%, right? If your down payment is less than 20%, then you have to pay CMHC insurance. Okay, along with the price of the property, you also have to pay CMHC insurance. CMHC insurance is an mortgage insurance, so that if you default on your mortgage, right, then the bank gets paid from the government. So it is effectively an insurance on your mortgage. It applies when the down payment is less than 20%. Okay. So what generally happens, this CMHC insurance is added to your mortgage. This CMHC insurance gets added to your mortgage. So we'll look at example. So let's say you're buying a, let's say, townhouse in Calgary for 400,000. This is the value of the house. Now if you 20% on that will be how much? 20% on that will be $80,000. If you put less than $80,000, then you have to pay CMHC insurance. The lower the down payment, higher would be the, let's say, CMHC insurance. So what we'll do is we'll see what happens at different down payment rate. So if you put 5%, if you put 10%, if you put 15%, and if you put 20%. So we'll see house value, we will see down payment, we will see mortgage that you get, and before mortgage we'll see how much CMHC fee you have to pay. So house value in all these cases is 400,000. Okay, so 400,000 is the house value for all these different, I'll just realign it so that you can see. 400,000 is the house value for all these different down payment percentages. Now if you are putting 5% down, so how much down payment you have to make? You have to make $20,000 down payment. If you're putting 10% down, you have to make $40,000 down payment. If you're putting 15% down, that comes to 60,000, and if you're putting 20% down, that comes to 80,000. This is the down payment that you are putting. Now you can also calculate CMHC fees. So there are a lot of calculators available. Okay, so I'll just give you an example. So our price was 400,000. In the first case, our down payment was how much? $20,000. Standard amortization. So let's say mortgage interest right now is 5% in the market. So we'll calculate. So yeah, mortgage insurance premium. So if you see, if I put 5% down, then my down payment comes to 15,200. So that will be my, like, sorry, not down payment, insurance cost. Okay, if I put 10% down, we can calculate that. So instead of 20, it is 40,000. I'll calculate 11,160. Okay, if I put 15%, that is 60,000. It comes to 9520. And at 20%, 80,000. So let's say 80,001. It comes to 0. Okay, so lower your down payment, higher would be the CMHC fee. Okay, now what happens? This CMHC fee gets added to your mortgage. So how much will be your mortgage in each of these cases? So your mortgage is house value minus down payment plus CMHC fee. So this is the formula for calculating mortgage. Your house value minus the down payment, that is how much you're taking as a mortgage, but your CMHC fees get added into the mortgage, so you have to add that too. So house value minus down payment plus CMHC fees. So 395 200, 371 160. Okay, and 349 and 320. These will be your respective mortgages, right, including the CMHC fee. So the important point is, if you're putting less than 20% down payment, then you have to pay CMHC fee. CMHC fee gets added to your mortgage. Now the issue with that is you pay interest on your whole mortgage. So you also pay interest on this CMHC fee for the next 30 years or 25 years, depending on the term of the mortgage. So our objective is accumulate as much down payment as you can before buying a house, because this is an insurance fee. When you sell your house, you're not going to get CMHC fees back. So you have to remember that CMHC insurance is a cost you never recover, right? So try and put at least 20% down payment on your house to avoid CMHC fees. Any questions? Any questions you have?
Sorry, the link that you shared, you have to grant access for us to be able to.
Sorry.
Thank you.
Yeah.
Anyway, can you download it later, sir, if you have done?
Sorry.
Yeah. Anyway, you can download it later if you have done your.
Yeah. I've shared the link again. So now you can view it. So just change the numbers in. So I'm going to create a lot of calculators in this class. So one calculator is this one. This is the CMHC fee calculator, right? So actually what we can do is we can use the CMHC rates instead of that, so that we build our calculator here. So 4%. Okay, roughly it will be some like almost that, not exactly. Exact is a little bit lower, but I'm just creating a calculator so that you can use it. Okay, 3.1%, so that you can roughly find out based on your values later on. When you do it, then 2.8, but to get a better idea, always use the calculator, but this just shows how much it is. Okay, so if you change the number, you should get approximately your CMHC fee. So 500,000 if you do house value, it will recalculate it based on the CMHC fee schedule. Okay, so this is the first calculator that we have created. It gives you a rough estimate of CMHC fees. Objective: always accumulate more than 10%. Okay, always accumulate more than 20%. Now next question is, how do you accumulate that down payment? So usually buying a house is a short-term goal. Okay, it's not a long-term goal, it's a short-term goal. Yes, under $1 million, it is for less than 5%. If it is more than $1 million, you have to put 20%. Okay, that's a good point. So if you are accumulating down payment, right, that down payment goal is a short-term goal. Now we will talk about which account to use to accumulate this down payment. So the best account that you can use to accumulate this down payment is first housing savings account. If you're buying your first house, this is the account you should use. First housing savings account. This was a new account that was launched in 2022. So it will apply from 2023. We have discussed this account, like, or we, if we haven't, it is combination of tax-free savings account and RRSP. So in first housing savings account, you get a tax-free growth. You don't have to pay taxes on whatever growth you get in this account. Plus you also get tax deduction, and the yearly limit is $8,000. Yearly limit for this account is $8,000. So it means you can save up to $8,000 for down payment every year in this account. Okay, when you invest that money, whatever it grows to, it's tax free, and plus you get a tax deduction. So you will get some tax back when you invest in this account. It is like RRSP. So depending on your tax rate, you will get a tax deduction. So let's assume your tax rate was 30%. If you are putting $8,000 here, so you will get a tax refund from the government for $2,400. Your taxes will be lower by $2,400. Multiply your tax rate by this deduction limit, or how much you're putting. Okay, so this is one of the best accounts to accumulate your down payment. You get both the features. The growth is completely tax free, all the income you get is completely tax free, plus you get a tax deduction also. If you are exhausted from this account, or if it is not your first house, then you can use accounts like RRSP or tax-free savings account to accumulate. In tax-free savings account, you just get tax-free growth. In RRSP, you just get tax deduction. Okay. So which account to use? If you can, we'll highlight this, use first housing savings account that will start from 2013. Next year it will start. So you can open this account from next year and you can start investing in that to accumulate down payment for your house. Now your house is a short-term goal, so you cannot take too much risk on down payment. So what things to put in to accumulate your down payment? Where to invest to accumulate your down payment? So you can add GICs into your first housing savings account. So you should look at investing in GICs. You should look at savings account, right? So just pure deposit account within your first housing savings account, so that you can accumulate for housing. You should not go to mutual funds, you should not go to ETFs, you should not go to stock market for accumulating down payment. Even bonds are risky, right? Bond market is down 20% this year. You do not want that to happen on your down payment. Okay, so it's important to not take risk on the down payment for your house when you're accumulating it. So it's a good idea to accumulate it using GICs or savings account. There is one another way to do it. There is something called as money market funds. So you can use money market funds also to do it. Personally, I prefer money market funds to accumulate short-term goals, accumulate money for short-term goals, because they give higher rate of interest. So if you just Google it, so let's compare money market funds and GICs. So let's say you're looking at GIC rates. So maybe we don't have 5 years, because in a GIC money gets blocked. You have to remember that you cannot access it before 5 years without paying penalties. Okay, so let's look at RBC or something. Yeah, so posted rates, if you say it's 2.25% on a year, right? Then 4.6 posted rate, always go by posted rate. They are running some offer where they pay a little bit higher interest for initial part and lower rate later on. So posted rate is 2.5%, 3.5%, etc. Right? So GIC rates are like, these are the GIC rates on a Royal Bank, right? The problem with GICs are, when you block your money, if it is a non-cashable GIC, you have to block your money. Cashable GIC, right? The interest rate is very low, 2.25%. Non-cashable GICs, the interest rate is higher, but you do have to block your money. Okay, so you don't get access to your money for that time period. GICs are relatively risk free, so good way to accumulate down payment for your house. Other way is, there is cash.to, which is a money market fund. It has like higher interest rates, so 3.5% interest rate on this fund, right? It pays you monthly that yield, plus it is very stable, it doesn't fluctuate. Like this will go from 50.07 to 50.13, so it doesn't fluctuate that much, and the yield is higher, the interest rate is higher. Okay, so this you can research it later. I personally use this for short-term goals because the yield is quite good, 3.79%. You put it in your first housing savings account, $8,000, 3.79% yield, and just let it remain there. Whenever you want, you can quickly sell it on the stock market and get your money right away. So this is one of the advantage. It's very liquid. You don't have to block your money for foreseeable future. Plus, you get good yields on this, and the risk rating is very low, because what they do is they collect money from investors and open deposit accounts with major banks and get interest on those deposits. So that's how they try to generate yield. Okay, so they invest in high interest deposit accounts with Canadian banks, and yield is 3.79% right now. So let's do some math now. So if you're using first housing savings account, your goal is to buy a house in 2 years, at the end of next 2 years. So you can put $8,000 here in first year, $8,000 in second year. You will get some tax back from the government, so lower tax rate or tax refunds. Let's say tax refunds. If your tax rate is, let's say, 35 or 32%, your tax refund will be this times 32% and this times 32%. So when you invest in a first housing savings account, $8,000, you also get a tax refund, right? When you file for taxes, 2,560 and 2,560 again back. Okay. Plus, when you invest in something like the cash, like money market fund, so that will grow. So let's say the yield is 1 plus 3.8%. So the first $8,000 that you're putting, that will grow for 2 years. The second $8,000 you're putting, okay, will grow for 1 year. So $16,923 you will get tax-free growth without taking any risk in your first housing savings account by investing $8,000 per year for next 2 years. Plus, you will get tax back from the government that you can keep in a separate savings account, right? And keep it there. So in total, by investing $16,000, you are getting $22,043 in 2 years for your down payment. So this is a plan you shouldn't miss out. Little bit of your down payment, if you're planning to accumulate, use first housing savings account to do it. Then you can use tax-free savings account or RRSPs to accumulate the rest. But always use this because this is a great math. $60,000 is what you're putting. You're getting $22,000, right? With this strategy. So effectively, you're growing your money by $6,000 in 2 years. Questions? Any questions? And it is tax free, no taxes on that. So especially most of you are young and most of you will be accumulating money for your down payment, right? Because most of you, it's a good idea to buy at least one house in Canada because you are paying your own mortgage, right? You are not paying someone else's mortgage. We saw mortgage payments in Calgary are lower than rents. So there is an advantage if you're living in Alberta to buy a house, right? Second thing, okay, is when it's a primary residence, so it is tax exempt when you sell, so you are accumulating money there tax free. Plus the economy is doing well because of oil prices, so we might have good growth in our real estate markets. I'm saying might because I don't know that, right? So it's a good idea if you are young and saving up for your real estate purchase, please plan to open this account when you can. First housing savings account, it can be opened with any bank you want or any investment broker like Wealthsimple, or Wealthsimple is the easiest way to do it because it's you can open it in within 5 minutes. Questions? And if you keep on doing it for like a little bit further out, so let's say you have a 3-year plan, then the math even changes even more. Okay, I'll show you the math for 3 years also, because 3 or 2 years will be one of the common goals for you. So this will be one more $8,000 for okay. So if you do it for 3 years, just 3 years instead of two, you get $25,000 tax free in your first housing savings account. Plus you get $2,500 tax back or tax refund from the government each year you file taxes. So that is 7,680. Keep that money aside. Do not use it for anything else. So in total, you're getting 33,550, right? In your as money. So you invested not 16 but 18 plus this times 3. So 24,000 you invested. So 10,000 almost you got extra. So at least do it for 2 or 3 years depending on your goal. The further out the years, the more would be the benefit. Okay. So I've shown you based on 2 years and based on 3 years. Questions? Next is, once you accumulate the down payment, you have to take on the mortgage. Okay, so we are going to discuss in detail mortgages. So what's a mortgage? Mortgage is you take money from the bank, borrow money from the bank, and you pay certain interest on it. For example, let's say you're taking a $400,000 mortgage. So this will be your mortgage that the bank extends you. Now this mortgage you are going to pay back most probably monthly. You can also pay it bi-weekly or weekly. Okay, before we go ahead, there is a question. What if the money invested in FHSA after 2 or 3 years, you change your mind but not to buy the house anymore? Oh no, that has to be used for buying a house. If you do not use that, you have to like pay taxes on it. So it will not be tax free, and plus you have to return the tax refunds. So you do have to use your first housing savings account for buying a house. Also, if there is one option, you can convert that FHSA amount after paying taxes into an RRSP. So you can shift that money into an RRSP if you have a room. But the tax-free status will vanish. Okay. So coming back to our discussion, when you take on a mortgage, you generally pay monthly, bi-weekly, okay, or weekly, depending on what you structure your mortgage back. So this payment that you make to the bank is composed of two parts. It will have principal that you pay back, and it will have interest that you pay back. So principal and interest you have to pay back every month. Okay, every payment you make monthly, that will compose of principal or interest, and this mortgage you generally pay back over 25 years. The mortgage term, the common mortgage term is 25 years. Right now there are 30-year mortgages too. Okay, so 30-year mortgages are also available. So I'll quickly show you, right? This is, you don't have to understand how it is, how I'm creating the mortgage table. It's not important at this point, but I just wanted to discuss a bit on that. So let's say you are taking a mortgage of 400,000. Okay, so this is your mortgage amount. Now let's say it's a 25-year mortgage. The term is 25 years. Okay, so you can calculate, so 25 years term, and the interest rate will look up. Interest rate on the mortgage, what's the interest rate? Mortgage Canada. So let's look at a big bank. TD is okay. So let's say the most common one is variable rate. So it is 5.2% right now. Okay, this is the interest rate that you have been given. So you can calculate the payment. Payment is how much you're going to pay monthly. So let's say your frequency is monthly. Your mortgage payment monthly will be payment your interest rate right now is 5.25%, but you're paying it monthly. So divide by 12. Number of period is term of the loan into 12. The total term of the loan into 12. Present value is this amount. Okay, future value of mortgage is 0 because you paid back, and you paid, let's say, at the beginning of every month. So your mortgage payment will be $2374 right now. Okay, $2374 right now. So this is another calculator that we have created that you can use it for your own self. So just change the mortgage amount. So let's say 487,000 is the mortgage, 25 years term, 5.2% interest, 2800 is the mortgage payment. Okay, just change the numbers and it will calculate the approximate mortgage payment for you. Now this is called as the mortgage amortization table. You don't have to construct it, but I'm just showing you how it will look like, and we'll discuss based on that. So first month, so it's a 25-year mortgage, so 25 times 12 is 300 months. So your mortgage is going to last for 300 months. Okay, so you start the mortgage with 487. You have a payment of this much on it, but you have some interest on, you have to pay interest on it also. So what I'm doing, I'm just going to calculate it quickly and then discuss. So this times 5.25% function f4 divided by 12. So this is a rough calculation. I'm not doing it precisely. You can like just Google mortgage tables and do it. It will do it for you, right? So this should be, see how it works. Yeah, yeah. So this is a mortgage table. So what's happening? You're taking a mortgage of 487,000. You are paying that back in 25 years. That is the next 300 months you're going to make payments, and the interest rate is 5.2720%, right? So you start your mortgage, you start making payments. Every payment you make, right? Some part of that payment will be interest. Some part of that payment will be principal. Whatever principal you're paying will reduce your mortgage. So 487 you started, 1 month you paid back, you are left with 486. 486 you started, 1 month you paid back, you are left with 485, so on and so forth. Okay, so each payment you make, you repay some part of principal. Okay, now what are the concepts that we are going to discuss based on mortgages? First is, how does increase in interest rate impact you? So let's say interest rates goes up from 5% to 5.2% to 6%. Okay, so what will happen? Your mortgage payment will go from, we'll calculate that. So 2,900 to 3,100. So the moment interest rates go up, your mortgage payment on a variable rate mortgage will go up. Okay. If interest rates go down, so they go down to 4%, your mortgage payment will go down. So when you take a variable rate mortgage, variable rate means your payment depends on the interest rate. If interest rate goes up, your payment goes up. If interest rate goes down, your payment goes down. Okay. So is the concept clear? Okay, so this is first thing. So let's return back to the interest rate right now. So when you take a variable rate mortgage and if the interest rates go up, you should expect to pay more. The second thing is, if you notice, when your mortgage is new, when you make payments, most of the payments are made out of interest. Principal is very low. So for example, the first payment that you make, $2,900 of payment monthly, out of that $2,100 is the interest, $700 is the principal. Okay, so the interest is very high when in the initial years of the mortgage. As you go down, the interest component of your payment will go down. For example, in the last years, when you make a $2,900 payment, most of it is principal, only small part of it is interest. Okay, so interest is higher in when the mortgage is new. As the mortgage gets older, your principal becomes higher. So they switch roles. Your payment remains the same, it is just a mix of interest and principals. Okay, so is the concept of mortgage clear? So a few points to note. When you take a variable rate mortgage, if interest goes up, payments go up. So there is always an uncertainty about interest rates because your payments will not be fixed in a variable rate mortgage. Now some banks, and this is a predatory like this, you should avoid these mortgages. There are certain mortgages which are variable, but they are called as target rate mortgage. Target rate mortgage means even if the interest rate goes up, your payment stays the same. You are paying the mortgage at a higher rate, but your payment remains the same. So what do? Instead of changing your payments, they keep your payments whatever it was before, but they change the duration of the mortgage. They increase the time on the mortgage. So instead of 25 years, you might pay 26 years or 27 years, depending on the interest rate, which is very, very costly for you in the long run because you are going to pay mortgages for additional years. That will be more interest paid on the overall house. So avoid these roles, avoid these loans. These are called as target rate loans. They are variable rate loans. So if interest rate goes up, you are effectively paying a higher interest rate, but instead of changing the payment, they change the duration on the mortgage. So they increase the length of the mortgage, which is very costly. Okay, so avoid target rate loans or variable rate mortgages in which payments do not change. So make sure when you're getting a variable rate mortgage, make sure that the payment is going to change if the interest rate changes. Okay, second thing to notice, you also have a fixed rate mortgage. I'll give you an example. So if you see fixed rate mortgages, this is an example of a fixed rate mortgage. So it's a 3-year fixed closed mortgage. It means that for 3 years, the interest rate is not going to change on your mortgage. After that, you have to renegotiate with the bank depending on the interest rate then. So the interest rate for that is 5.59%. You can also buy a 5-year closed mortgage, which has an interest rate of 5.54%. Okay. in which the interest rate is going to be fixed for you at 5.54%. Okay. Questions? So I'll just move this aside so that we can continue our discussion. So what should you be careful about? So you have two options always, variable rate or fixed rate. Now this strategy will give you a lot of money, right, over the long run. Now if the expectation in the market is that the interest rate is going to go up, so we'll write down interest rate expectation. If the expectation in the market is that the interest rate will go up, right, always take a fixed rate mortgage, because interest rates are low right now. You're expected to increase the interest rates in the future, so it's a good idea to block your mortgage. For example, like 1 year back the interest rate on the mortgage was 2%. So if you would have gotten this mortgage 1 year back, the interest rate would have been 2%, 2.5%. In that case you should have booked your interest for the next 5 years, because then everyone else will be paying a higher interest rate but you get a lower interest rate because you have fixed it. So if the interest rate expectations are that interest rate are going up, are going to go up in future, it is a good idea to go for fixed rate mortgage. If the interest rate expectation in the market is down, that the interest rates are expected to go down, it is a good idea to take variable rate mortgage. Because if you get a fixed mortgage rate and the interest rates go down as per your expectation, then you are paying at a higher interest rate when everyone else will move to a lower interest rate. So imagine, like, if the interest rate becomes 7% on mortgages and you fix your interest rate at that point for the next 5 years, and after that the interest rate starts to go down, then that will create an issue. Okay, so this is based on your interest rate expectation. You should book your mortgages. Right now the expectations are that the interest rates will go up further, at least till 2023. Now what is a trick to know what should you do when you look at mortgage rates? So this is a small trick that I have gotten, right? This is not official, it's not given anywhere, right? You cannot research it also. A small trick is compare variable rate and fixed rate. Okay, if the variable rate is lower, the banks want you to go for variable rate, because the interest rates are expected to go up. They want to catch you, right, by giving you special offer on variable rate instead of fixed rate, so that you take this instead of this and the interest rates go up and you pay higher, right? So whenever variable rate is lower than fixed rate, you should go for fixed rate. If fixed rate is lower than variable, then you should go for variable, because banks want to make money, right? If they catch you by giving you 5.2% right now, but 1 month from now when the interest rate increases, you're going to pay 6.2% here, right, instead of 5.54, they make more money from you. So banks will start providing offers. So if the variable rate is lower than fixed rate, you should go for fixed. If fixed rate is lower than variable, you should go for variable. This is a small trick that you can follow. This is based on the logic that banks know what they're doing. Banks will try to make most money that they can from you. If they can make more money from fixed rates from you in the future, they will offer fixed rates that are lower than variable. If they can make more money from you by offering variable rates, they will offer variable rates that are lower. So right now they want to catch you at a lower rate, okay, so that the interest rates go up in future, you pay more than the fixed rate available right now. If the situations are turned, so right now if I have to go for a mortgage, I will take a 3-year fixed mortgage. Even if I have to pay a bit more right now, I can always renegotiate after 3 years. Or I would even go for a 2-year mortgage if it is available and fix it for the next 2 years. So I'm like shielded from the interest rate hikes. Okay, because the variable interest rate is lower than the fixed rate. If the situation is reversed, then do vice versa. Questions? Questions? Fixed rates for new mortgages change, right? But fixed rate on the mortgage already taken will not change. So there is a good question. Do fixed rates change at the same time variables rates do? So I'll give you example. So this is like October month. Okay. This is October 24. Then October 26th is the policy date for Bank of Canada when they are going to increase the interest rate. Then November 26th is the next policy date. Okay, so I'll give you examples. So let's say you take a fixed rate of 5.5% for 3 years. Then if you do 5.5%, your mortgage payment will be 2990. Whatever happens, your mortgage payment will not change. You are fixing your interest rate on your mortgage for the next 3 years. So whatever happens, so if you just drag this, okay, your mortgage payment will not change. It will be same. You can also, and let's do it for 1 year. So let's say you have an option of getting a fixed year mortgage rate for 1 year. Okay, so I'll move this to the side. I'll move it to a new sheet because this is important to understand. If you have to refer, you can refer it later on. Okay, just blocks the way. Okay, so we are taking a 1 year fixed rate. So October to October. So 1 year fixed rate, no matter what happens, you'll not pay payment here because, sorry. Okay, so no matter what happens, you are going to make total payments of 44,850. Okay, fix year 1 rate, fix year 1 year mortgage, 5.5% you got. Now you didn't attend this class, so you didn't know what is happening. So you took on a variable rate mortgage and you were very happy. Oh my god, I'm getting a good deal because it is 5.2% right now. So In October, the interest rate was 5.2%. So you were very happy because if you calculate it, 5.2%, your payment will be lower. It is 2903. Okay. So effectively, you're saving some money here. You're saving $87 right now. But the policy rate went up. So let's say policy rate is expected to go up by 75 basis point here. So this plus 0.75%. Okay, and then it is expected to go up even further. So this in November it goes up further 0.5%. Okay, and it stays there. So what will happen? Your mortgage payment will now change. So it will be 5.95%. So that will be 3,122. Then your payment will go up by 6.45%. So that will be 3,273. So let's say the rest of the payment doesn't change because they freeze the interest rate increase for the next 1 year, which is not expected. Interest rate is expected to go up till March of next year. Okay, so if that happens, what's happening now? First month you saved money, next month you paid extra like nothing, so this is zero payment. Okay, from here you will either save money or not. So first month you saved money, but all the rest of the month you're paying $283 extra. Okay, because you took a variable rate mortgage, and in total, if you see, you're going to pay $3,800 extra. This is how banks make money. They incentivize the interest rates because they know like till March the interest rates are expected to go up unless until we go into deep recession. So they are taking a risk on that, right? And unless and until we go in deep recession where they have to start cutting the interest rates are expected to go up. So they are forcing people or incentivizing people to take variable rate, right? If you take variable rate, you will be happy this month because the interest rate is low, you save $87. But for rest of the whole year, you're going to pay $283 extra. So in total, $3,875 extra. So this is a trick that banks do. Be careful about that. If you're getting a better floating rate, always think what is the interest rate expectation. Maybe I get a fixed rate right now because interest rate might change a lot. Okay. Now there is a question, do variable rates, okay, so 1 year from now, you have to renegotiate with the bank. If you fix your rate with for 1 year, whatever is the interest rate 1 year from now, of course, you have to renegotiate with the bank for that interest rate. But for 1 year, the payments remain fixed. So they tied together at whatever time you get the mortgage. Was just curious if they could change independently. No, they are not, they don't change independently. Questions?
I have a question.
Yeah.
So when you said that after that year, you can negotiate with the bank, if the interest rate increase, can you negotiate to keep on this same
No,
rate that you were?
you have to take whatever is the market interest rate then.
Okay. Okay.
But
Thank you.
at least like you saved $3,000 for the given year, beyond which you have to again negotiate, right? So at least for the next, right, 1 year or so, you saved $3,000, $3,800. That's the expectation. So like March is like, if you see Bank of Canada policy rate peak, that's what the market is pricing in. We don't know that if the inflation remains high, Bank of Canada might keep on continuing to increase the interest rates. So Bank of Canada in Bank of Canada interest rate peak expectation. So if you read this article, because I was basing that on Federal Reserve. Federal Reserve gives something called as dot plot. So dot plot is suggesting that interest rates would peak around March and they should be expected to be around 4.5% policy rate. So mortgage will be roughly around 8 like 6.5% plus, right? But it depends on the interest rate. See, it's the March month. So March month is when the interest rate is expected to peak around 4.5%. So you can just derive a correlation. Interest rate right now is 3.2% or 3.5%, if I'm not wrong. So interest rate right now is 3.25%. So it's expected to go to 4.5%. That is 1.25% up. So if it goes 1.25% up, mortgages will also go up by 1.25% at least. So next year mortgage is going to be, like in the month of March, the mortgage is going to be 5.2 right now plus 1.25. So 5.25 plus 1.25, that is 6.5% is the peak mortgage rate that the Bank of Canada is right now expecting. Okay, roughly it could be here and there, but that's the rough estimate. So if that happens in the month of March, then it makes sense. Okay, so if it does peak in March, you will see the reverse of this. So that TD thing that we were discussing, you will see reverse in March. So if you go to a bank in March, right, and the interest rates have peaked, they will show like variable rate, let's say at, I'm saying 6% everything. So variable rate may be at 6.75% and the fixed rate will be somewhere around 6.5%. So you will be like, oh my God, I should get a fixed rate because it is lower than variable. But no, then you will game yourself for the next 3 years. When interest rates start coming down, you will be caught up making payments at a high rate. Okay, so that's how this system is gamed. So which link you're suggesting? There is a question, can you download the link at the end of the class? Which link, like, I'm not getting it. Just clarify it in the chat. Okay, no worries. So we'll write it down to our strategy. This is not given anywhere. This has worked for me, right? I have an interest rate that is blocked at 2.5% for the next 4 years because I renewed my mortgage in the pandemic. There was no renewal date, but I paid a little bit extra. I paid a bit of fine on that, but I did block my interest rate at 2.5% for the next 5 years. Okay, next remaining 4 years now. So if you know this strategy, you save a lot of money. So what's the strategy? If variable rates are lower than fixed rates, probably interest rates in the future might go up. So banks wants you to take the variable rate so that you pay extra. So be careful, might want to look at fixed rates, even though they are higher right now. If variable rate is higher than fixed rate, interest in the future might go down. So be careful, you might want to look at variable rates. So these two statements, make a note of it when you take on mortgages, which you would probably going to do, like do this strategy. Any questions? The next thing that we're going to discuss based on mortgages is you can and should look at prepaying the mortgage. Can you switch from variable to fixed anytime? Depends on the mortgage. If you have an open mortgage and it's a convertible mortgage, you can convert between those two mortgages anytime. Fixed to variable, variable to fixed. But those mortgages are little bit more expensive than normal ones. Normal ones you cannot break. So convertible mortgages right now, you should probably get one because you don't know where the interest rates are going. It's a good idea, even if you're getting a fixed mortgage, to get a convertible one. Okay.
What if you have a fixed mortgage for 1 year? After the year, can you transfer over to a variable mortgage?
Yes. If you have done a 1 year fixed mortgage, like in this case, when 1 year gets over, you are free to negotiate with the bank anything you want. You can take a variable rate mortgage, you can continue with the fixed mortgage, you can get a fixed mortgage for next 10 years if you like. So it's a open mortgage then. It's a negotiation. Okay. The next concept is prepaying the mortgage. What is prepaying the mortgage? So we saw the mortgage schedule. So prepayment means you directly put money towards the mortgage, towards the principal. Okay. So let's say first year, I am prepaying $5,000. Okay. So what will happen? The second year's mortgage or first year, so this is monthly. So after 12 months, I'm prepaying $5,000 directly on the principal. So what will happen? The next year's principal will be gone down by $5,000. So straight away the principal reduces. Straight away the principal reduces. Okay. So that will reduce your mortgage, right? See, the mortgage is getting over before. So mortgage is actually getting over somewhere in 292 months. So 8 months early. So by paying the mortgage off, by prepaying the mortgage, you reduce the duration of the mortgage. No, most mortgages allow you to pay, depending on the bank that you're negotiating with, but most mortgages allow you to pay 15% of principal in a given year without any penalties. Beyond that, there is a penalty. 15% of the mortgage you can pay without penalties. Rest of it you have to pay penalties. Now, the interest rate in the market is like when the interest rate on the mortgage was 2%, there was no point on paying it before because like when you prepay a mortgage, effectively that is what your investment is making. So if you, example, you have a 30-year mortgage and you're paying $5,000 off this year, then effectively what's happening? The interest rate right now is 5.2%. So this $5,000 of yours is generating 5.2% interest for the next 30 years. So that it is like an investment. When this interest rate was 2%, there was no point on paying it back, because there's like a stock market and stuff, you would have got 7-8% return, right, on an average. But right now, the math is that you should start paying more, as much as mortgage as possible, right, prepaying it, because you're effectively getting risk free 5.2% on your money, risk free for the next 30 years. So that's big savings. Okay, so that's the reason when interest rates are high, it is very important to prepay your mortgages, because the savings will be enormous and that is risk free. It is like investing in a Government of Canada bond at 5.2%. It is something like that, because mortgage is a debt. First of all, your debt goes down. Second of all, it's a risk free kind of return for the next 30 years that you're getting at this high of an interest rate. And if interest rate keeps on climbing, the math even works in the favor of prepaying the mortgage. So that's the first thing. When the interest rates are high, always focus on prepaying your mortgages. Okay. Second thing, when the mortgage is new, most of the payment you make will be interest, right? So it is better to prepay it, because anyways the payment that you're making, most of it is going towards interest. So if you prepay the mortgage, you save on that interest. When the mortgage is old, right, let's say you are in the last few months of the mortgage or last year or two of the mortgage, most of the payment you are making on the mortgage is principal, it's not interest. So then there is like less point of paying the mortgage back. So two things: when the interest rates are high and the mortgage is new, pay back as much as you can. Pay back as much as you can. If the mortgage is old and the interest rate is low, no point on paying. Invest your money somewhere else. Bank of Canada bond is giving you right now 3.2%. But if you prepay your mortgages, which you have at 5.2%, that's effectively the money you're making. So that's enormous. And you can calculate that. So I'll show you how to do it. So there are prepayment savings calculator. Let's see if this works. Yeah, so let's say you have a $400,000 mortgage at interest rate right now is 5.2%. Okay, and it's a 25-year mortgage. The remaining term is 25, so you have just started the mortgage. Okay, it's a brand new mortgage, and first year you save up your money in, for like, let's say a tax-free savings account, and invest it at like, let's say 3.2% or something, and you paid back $15,000. Okay, what's happening when you pay back $15,000, right? Effectively you're saving $36,500 on that mortgage in total interest payment, accelerated saving. Why? Because your mortgage duration goes down. 15,000 payment in the first year itself will reduce your mortgage by almost 2 years. So instead of 25 years, your mortgage is now 23 years. The more you pay, shorter will be your mortgage, right? So prepayment is enormous, like value of enormous value, especially if the interest rates are high. If this is 6.2%, the savings will be even more. Okay, savings are $50,000 now in the total interest. Okay, and the mortgage goes down even further. So always remember to prepay your mortgages, right, when they're new and when the interests are high. Instead of taking money on risk on your money, especially in the stock market and stuff, try to pay as much as you can and then start investing. Okay. Now, how can you prepay? So there are different payment options. So you can prepay lump sum. Lump sum means one time, which is generally every year you can pay 15% of remaining mortgage. Over and above that, you might have to pay a fine. So be careful not to overpay. If you're paying lump sum, that is one time, 15% of the remaining mortgage you can pay back. Then there are other options too. You can double your mortgage payment for certain months. So let's say your mortgage payments was 2900 for like 2 or 3 months in a year, you can pay twice of that. So 5806, the 2900 extra that you're paying, that will straight away go to principal. That will not have any interest payment in it. That will straight away reduce your principal. So second option that people might employ is double your mortgage payment for certain months. Third option that you can employ is most banks will allow you to pay 10% extra of the mortgage payment every month. So your mortgage payment is 2903. So you can effectively pay 10% extra, that is 290. So in total, you can increase your mortgage payment up to 3193. Okay. And which is very counterintuitive, because when interest rates are high, people are like, oh my god, the mortgage is so much, I should probably try to reduce it. So they negotiate with the bank generally to increase the term. Instead of 25 years, they go to 30 years to reduce their payment. But that will be enormous amount of interest you're paying, because if you see the total interest that you pay on a $400,000 house is like 782, which is very high. Almost twice of that you're paying in interest over the years. Doesn't make sense, right? So when the interest rates are high, try to use all of these options. Try to make lump sum payments as much as you can. Try to, if you're getting some additional money, increase the mortgage payment, make it double, right? Work a plan out to reduce your mortgage as much as you can when the interest rates are low, interest rates are high. If the interest rates are low, then like there is less point of paying the mortgage when it is at 2.5%. There is always a point to paying off mortgages, because mortgage is a debt. It's a good idea to remain or live debt free, right? But especially this becomes more valuable, the prepayment becomes more valuable when the mortgage rates are high and the mortgage is newer. Questions? Okay, so I guess that's it for today. Like it will be too much, because the next is like, what are the criterias for mortgages, how much can you qualify? So I'll share the Excel sheet with you, Excel link with you. Okay, and that's it for today. It will be too much otherwise.
We have a midterm, correct? From
Yes.
which, from chapter
So
1?
till real estate. So till chapter 6, chapter 5, I guess, real estate.
Okay, thank you. And we have to
Yes.
do it before the 31st, right?
Before the deadline, yes. So whatever we have discussed till now, that is part of it. So if you go to learn, I'll show that to you. Let me just